Madan Sabnavis, chief economist at Care Ratings, now joins in on the show. Madan, great to have you with us. And of course, I think it's the GDP numbers is what's keeping everyone on tenterhooks. So with respect to the annual GDP estimate tomorrow, what is it that Care Ratings is expecting?
In fact, for the year 2013-14, we are looking at a number of 4.9%. And I think the kind of a revision which we had last week for 2012-13 will actually enable the GDP growth number to move towards 5%. Because I think this entire process of redefinition of the way in which one calculates GDP, especially for the manufacturing sector, I think that's been the major difference, is probably going to provide an upward kind of tendency for the current year also.
Okay, that's the call coming in on the GDP numbers, but what is it that you would be doing with the rupee? Because while we have seen quite a few events that can impact the movement of the currency, such as the QE taper, the way the equity markets are panning out, the movement of the dollar index as well, the rupee hasn't seen too much of a movement, and we've barely deterred from that 62.5 mark. Where do you see us headed?
In fact, we'll have to look at two sets of factors that are going to keep driving the rupee going forward. I think one would be what happens on the trade front, and the second is, of course, what's going to happen in terms of what the Federal Reserve is likely to do. Now, in terms of the Federal Reserve, I think it's quite clear that we could be expecting this $10 billion cut on a monthly basis. So it'll have to be seen as to how do these funds flow really behave as far as India is concerned. And so far, we have seen that after the last tapering announcement of $10 billion last month, we have actually seen the FI flows turning slightly negative. So I think that's going to be one factor which is going to play on the exchange rate. The other is, of course, what happens to our trade numbers. See, so far I think we've had a certain kind of a buoyancy which has come into our exports on account of a negative base of last year, as well as the rupee depreciation. Now that we have seen that the rupee has been generally stable in this region of around 62 rupees to a dollar for quite some time now, I think that export competitive edge which was there earlier may probably start to dwindle. So I think these are the two factors which are going to play on the rupee. So for the short term, we could still be looking at something like 62 to 63. And if at all things do strengthen a lot, I think 61, 62 could be something we could be looking at when we start the new financial year.
Madan, things seem to be looking up for us, at least when it comes to the government finances situation. They seem to be in good shape after the telecom auction seems to have garnered such a healthy sum of money. The RBI has cancelled the government bond auction. What's your view on what this means?
No, I think they're definitely positive signals as far as the fiscal deficit is concerned. I think the FM has been reiterating for almost 6 months that a red line will not be breached. So we're really working backwards on this 4.8% number. Now, we have seen that there have been quite a few expenditure slippages, especially on the subsidy front. And that's something which is probably going to be corrected more by cutting back on development expenditure on the capital side. I think that's a negative for growth, but in terms of the fiscal balances, I think it provides quite a bit of countervailing power as far as the expenditure is concerned. Now, on the revenue, I think there's been a certain kind of a bonus which has come in, both in terms of getting higher dividends from the public sector units, that's number one, and two, in terms of the spectrum sale. Now, one would guess that probably 1/3 of what we are talking of. So in case the spectrum sale is talking of something like, say, 50,000 crores, we could be expecting something like 15 to 20,000 crores to come in this particular fiscal. So this is something which is definitely going to help the government to balance the budget. I think that's the main reason as to why they have cut back on that particular expenditure, on that particular borrowing, which was to have taken place in January, now being deferred and probably being cancelled forever. So on the whole, I think the government's borrowing program as such is going to be well within control, well within the mark, and maybe there could be some kind of cutback in terms of what was projected last year. And that's good news as far as market is concerned, as far as liquidity is concerned, as far as the G-Sec yields are concerned.
Madan, how do you think the markets react to the different points then? Because clearly if everybody believes that the 4.8 number will be met this way or that way, then there won't be too much of a reaction to that data coming out. In all probability, maybe some bit of reaction to the GDP or to the policy as and when the announcement comes in.
No, I think the rates will remain fairly stable as of now, but I think the only factor which we should keep in mind is that as we get into the end of February and March, there will be the advanced tax payments, as well as some kind of pressure on banks to also meet their targets in terms of credit. So that would be the second thing. Mutual fund redemption could be a third factor. And last of all, even in case of the spectrum auction money to come in, finally the money will have to come from banks. So I think there will be certain kind of pressure on liquidity in the end of February and March. So therefore, the kind of comfort we are seeing today of the market yields moving slightly downwards could probably get reversed, say, in another 2 weeks or so.
Run us through then, what you make of the movement of the bond yields, because while the bond yields have certainly eased, the short-term borrowing costs for the government, that continues to remain rather elevated. And, most of the bond market experts are talking about this being attributed to the liquidity shortage, which is anticipated post-March. Your opinion?
Yes, that's exactly the thing. We're talking of March. There's going to be a liquidity problem as far as banks are concerned. So I think even in terms of the term repos will probably come back into action as banks will be seeking this particular window in order to get liquidity to balance whatever the requirements are. So I think liquidity strain is going to continue to remain. Of course, it's going to be of a temporary nature. I would say it's more of an annual kind of a feature which we're going to go through, probably exacerbated to a certain extent on account of the higher demand for credit. But so whatever downward movement we are seeing in bonds as of now is going to be short-lived.
What is it that you're expecting by way of rate action from the Reserve Bank in the coming quarters?
So if you're looking at the RBI's action, I think they've made it very clear that they're going to follow the CPI as the target. And we are looking at the CPI numbers easing gradually. Probably we'll still be in the 9 to 10% range. But I don't think that will be adequate as far as the RBI is concerned before they take any interest rate action. So it's a whole question of saying that how do we conjecture the CPI inflation number to behave, say, in the month of February? Because I think that would be the last data point which the RBI would have when they have the next policy in April. And to my mind, well, the number will be moving downwards, but it would definitely not be as close to comfort moving towards the 6% mark which we spoke of for 2015 to take any kind of interest rate action. So I think the best case scenario will be that in case the CPI inflation number moves downwards for both January and February, there could probably be a status quo in the month of April.
Fair call, Madan. We'll leave it at that. Thanks so much for joining me today on this discussion and giving us your views on the macro.